Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 12, the Group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so problem 12-38, excuse me. All right, so you're given an income statement compared with an industry average and a balance sheet compared with the industry average. Right, so common size financial statements and profitability ratios. Okay, let's see here. Common size financial statements. What is, go back and look in the textbook, excuse me, for what common size means. Basically, you're converting dollar amounts into percentage amounts. Remember, by using percentages, that gives us the basis to be able to compare bananas with bananas, whereas when you're looking at information, in dollar amounts, oftentimes you're looking at, comparing apples with oranges. You can't. But by converting things into percentages, it allows you to be able to make the proper comparisons. As you can see here in an industry average, these are all in percentages, right? By having dollar amounts here, right, that doesn't tell you anything. All right, you have no basis to be able to compare against the industry average. So you can convert all of the dollar amounts into percentages in order to be able to make a comparison between two different things. So it says here, Johnson asked for help in comparing the company's profit performance and financial position with the average of the auto industry. The proprietor has given you the company's income statement and balance sheet as well as the industry averages for retailers of used autos. Right, requirements. Prepare a 2-column common size statement and a 2-column common size balance sheet. The first column of each should present Johnson's common size statement and the second should show the industry average. All right, so for the profitability analysis, all right, we'll get to that in just a second. What they're asking here for number 1 is, again, if you understand common size, what they're asking for is that you change all of these dollar figures into percentages. Now, I'm not going to recreate the financial statements. I'm not going to redo it. You can look at the solution in, you can look at those statements in the solution manual for this exercise, for this problem. What I'm going to do is I will, because these are my working papers and all my understanding is that I just need to convert these dollar amounts into percentages. Well, I'm going to do that right here, okay? But the reality is that if you were going to present this information to someone else and it's not your working papers, well then instead of, you would basically reproduce these statements, but instead of having dollar amounts here, these would all be percentage amounts, okay? But for saving time and that type of thing, like I said, I'm just going to create an additional column here with the percentages here, okay? All right, and then number 2, it says for the profitability analysis, examine Johnson Auto Sales ratio of gross profit to net sales, ratio of operating income to net sales, ratio of net income to net sales. Compare these figures with the industry averages. Is Johnson Auto Sales profit performance better or worse than the industry average? Then 3, for the analysis of financial position, examine the ratio of current assets to total assets, ratio of stockholders' equity to total assets. Compare these ratios with the industry's average. Is it better or worse? Right. So let's do the number crunching. All right. For the income statement, we use sales, so that's going to be 100%. That's going to be our base. and then all of the percentages are based upon that. So basically, you're taking the for the cost of goods sold, you have 577.8 and dividing it by the 961.1, and that percentage is 60.1%. Right, subtract one from the other, that gives you 39.9. Okay, and then for my operating expenses, I have the 302,400 divided by the 961.1, and that gives me 31.5. 31.5. Right, so my operating income, subtract one from the other, is 8.4. And then my other expenses is 5,600 divided by 961.1, and that gives me 0.6. And we subtract that from that, and that gives me my net income is 7.8%. Okay, that's the income statement. You know, all you're doing, to double check yourself, you can just do that. You're taking the 961,100, you set that for at 100%, and then all of the rest of these numbers, you take each number and divide it by 961,100 in order to get all the percentages. Now, yeah, I did take a shortcut, right, in that I can do math here wherever the math is applicable, right? And you're doing the same thing over here with your balance sheet. Okay, with your balance sheet, your total assets are going to be 100%, and that's what you're going to use for your assets. So you have 287,300 and divide it by 406,600, and that gives you 70.7%. So 70.7%. And then you're going to do the same thing. 95,900 divided by 406,600 gives you 23.6. 2,600 divided by 406,600 gives you 0.6. And 20,800 divided by 406,600 gives you 5.1. Okay, that's my assets. And then I do the same thing with my liabilities and equity. Right, the 406,000 is 100%, right? And I take the 200,500 and divide it by 406,600, and that gives me 49.3. 75,900 divided by the 406,600 gives me 18.7. And 130,200 divided by 406,600 gives me 32%. So that's all there is in creating a common-sized statement. Okay, number 2 here. All right, so for number 2, it says, for the profitability analysis, examine Johnson's auto sales, the ratio of gross profit to net sales. Right? So my gross profit is 39.9, right? And the industry average is 36.8. Okay. So that's better than the industry average, right? Because it's the industry average is 36.8%, and Regal is 39.9, right, percent. So that's a plus, right? But the ratio of operating income to net sales, so if I look at my operating income of 8.4% compared to the industry average of 9.3, That's not so good. That's less compared to the industry average. And the ratio of net income to net sales. So my net income here is 7.8, and the industry average is 8.8. So that's a negative, right? So compare these figures with the industry average. Is Johnson's auto sales profit performance better or worse than the industry average? Okay. Well, I'm not going to say obviously, because even though we have a higher gross profit compared to the industry average, right? Our operating income is less. Okay. Our operating income is less, and our net income is less. And what that means is that we have we've actually spent more, right? So even though we're doing good in terms of our cost of goods sold is concerned, right? And because we have revenue, and less our cost of goods sold gives us our gross profit, even though we're making more money on our sales, or we're buying the product at a less amount in order to be able to have a greater profit on the product being sold, our selling and admin expenses have increased, and that's what's killing us, as reflected in the lower operating income and the lower net income. So in comparison to the industry average, Johnson's auto sales is not doing as well profitably. Okay, so yeah, you can you can sit here and go and say, if you go and you just look at this 7.8% right here as compared to the 8.8%, and just say, oh, is my profitability up or down? Well, yeah, that's down, but why is it down? All right, it's down because we're selling our admin expenses, our selling and admin expenses are greater. We're actually doing much better than the industry average as far as gross profit is concerned. Meaning, let's just say, the car costs 50,000, and our cost on the car is 30,000. Right? Well, maybe we're selling that car instead of for 50,000, we're selling for 55. Right? Or maybe instead of buying it at 30,000, we're buying it at 25. So we're actually making more money when we're selling the car itself, and our income, our profitability of selling the car is better, right? But when we look at the bottom line of the company, we're actually doing worse than the industry average because the rest of our expenses are too high. Maybe we're paying our people too much. Maybe we're spending too much on advertising. Maybe our utilities are too great. All right, electric and stuff like this. All right. So that means that Johnson is, when we look at where's my pen here? Come on, pen. There it is. When we're looking at the bottom line here, it's easy to say, oh yeah, we're not doing as well. But the real question is why aren't we doing as well? Right? So that's number 2. And okay, so let's see here in number 3. Right, so it says here, for the analysis of financial position, examine Johnson's ratio of current assets to total assets. Right? So its current assets are 70.7, and the industry average is 71.2. Right, so that's pretty close. Okay. Ratio of stockholders' equity to total assets. Right, so my stockholders' equity is 32, and the industry average is 35.5. Okay, so that's not so good. All right. So what does this mean? All right. What it means is that for our assets, we're actually buying more in, we're spending more in terms of debt is concerned, right? Because even though our assets are similar, our equity is below the industry average for our stockholders' equity, which means our liabilities are greater. So our assets is equal to liabilities plus equity. So if I had, let's say, just as to be able to think about the concept, if I had 6 for assets, okay, and I had 2 for equity, that means my liability is 4, which is greater. But if I had 4 for equity, right, then my liability would be 2, right? Okay, so when I'm looking at this, if my industry average of the stockholders' equity is 35, right? So let me erase a little bit here and give you a little bit different numbers to be able to identify this a little bit better. Say this is 60, okay, and we're saying this is 35. That means our liabilities are 25, okay. So, oops, I'm sorry. And this is in, I shouldn't be using dollar amounts. I should be using percentage amounts. I'm sorry. So this is 100, right? So that means our liability here is not 25. Our liability is 65, okay? If that means our liability, in order to pay for our assets, we're using more for our liabilities than we are, in order to pay for those assets, than we are using for our equity, right? And because of that, that makes it more difficult for us in the future to be able to obtain financing when we need it. So let me just run that by you again. Assets is equal to liabilities plus equity. And I'm sorry for using amounts instead of percentages. So if my assets have 100%, okay, and I have 35% for equity, that means my liabilities have to be 65%, right? Now, if my equity goes down to say 25, that means my liabilities would go up to 75, right? Which means there's a greater percentage of my liabilities I'm taking on more debt in order to be able to pay for those assets. If my ratio changed to where my equity was 55, right, then that means my liability would be 45, right, which is a good thing because I'm not spending as much debt. I'm using capital here in order to finance or pay for my assets. Remember, equity is not only about stockholders' equity, it's about retained earnings. Also, the profit and loss that you have at the end of each accounting period goes to that retained earnings account, which is part of your equity, right? So by having equity at 35%, 32, even though it is less than the industry average, okay, that means the company in and of itself is taking on 68% in liabilities. So their debt, that they're taking on more debt in order to be able to finance those assets, all right? And that's not a good thing because they at such a high percentage point, you reach a spot where if I need to be able to buy more assets, you're not going to be able to take on more debt. You're not going to be able to get the financing for it because your liabilities are already too high. And that'll force you into looking at ways in order to get more equity. But how do you do that? Well, the two ways are you create net income, right? Or you get additional capital through, common stock. And if you're not able to get through common stock, you have to look for other investors to invest money in the business, right? Which is not a good thing, right? So that's the profitability picture on this particular company, right? So with that said, watch the video again. Sorry for the mix up a little bit on looking at these as dollar amounts instead of percentage amounts, right? But that's why we convert our numbers into percentages, right? to be able to compare apples with apples, and to be able to make a little bit better common sense of what the ratios are telling us. So watch the video again, and if you still don't understand something, feel free to contact an instructor. All right, see you in the next video for the next problem.